What is going on, everybody? Welcome back to another episode of That Makes Zero Sense, the podcast. My name is Alex Ivanovich. I am a trader slash investor at Spoonbill Partners LLC. I trade stocks, bonds, derivative products, public and private markets, you name it, and I've probably traded it at some point. For today's episode, we are going to discuss three different topics, two topics involving the market and things that I've been seeing, not just in macroeconomics, but also microeconomics. And then the third topic that we're going to discuss today has got to do with trading. I have a quick little trading lesson for all the viewers. That should be interesting. I love doing those segments. Those mean a lot to me, and I've learned a lot over the years. So sharing that knowledge with you guys, I think, is an important part of this show. So without further ado, we're going to jump right on into the episode. The time of this recording is Wednesday evening. It's roughly 8:15 p.m. East Coast time, 5:15 p.m. Pacific Standard Time. And the first topic of today is we're going to discuss this SK stock buyback. So they announced that we're going to buy back $29 billion worth of stock and then cancel the stock. So meaning destroy it. It's not going to be tradable or ever get sold again. It equates to roughly 3.3% of their outstanding shares. So for those of you who don't understand, a buyback is construed as positive for a stock. Obviously, the fewer shares there are outstanding, the actual valuation of the company doesn't change, but there's fewer slices of the pizza. So your slice of the pizza, i.e., your holdings in that company, are technically worth more. And so usually shares appreciate, and it's a positive thing for the stock. It's usually called like a return of capital to shareholders, and that can either look like a dividend or it can look like a share buyback. And so in this case, it was a share buyback. So just to provide a little bit of context, obviously this company produces memory, no different than SanDisk, Micron, Western Dig, Seagate, some of the other companies that we've discussed in great detail on this show. They produce memory, and obviously the memory market in Korea has grown massively. I've written down a few numbers here. The memory market in 2025 was 360 trillion won. And for those that don't know, won is the currency in Korea. And then in 2026, that number, 360 trillion, grew to 1,500 trillion. And then in 2027 is estimated to be roughly 2,100 trillion won. Now, in the same week that this stock buyback was announced, a company in China by the name of CXMT, which also produces memory, just became China's most valuable listed company. Now, why am I bringing all this stuff up about memory and this company in China? Memory prices are high. That's no shock to anybody. Many company CEOs over the last quarter have discussed the input cost to some of their devices, i.e., and they specifically call out memory, has been so expensive that it is starting to eat into their margins and harm their profitability. Memory prices are actually so high right now that they're starting to show up in some of the inflation data that we're getting. So the reason why I think this is a little bit silly, the stock ripped today on that news of this buyback occurring. It was a relatively pretty small buyback, like I said, 3% of the shares outstanding. So it's not a huge needle mover. I think what's sort of going on here is that companies in this space are starting to pick up on the fact that there might eventually be a supply glut of memory, even though it's not showing up right now. That might be the case at some point. And we just came off of a bear market in Korea, where some of these stocks in Korea, like Samsung, like SK Hynix, got chopped in half, sometimes even more than half. A lot of names in Korea got absolutely decimated. And to come off of that and then do a share buyback, I think is sort of trying to place this band-aid on top of a gunshot wound. And then you also simultaneously, with everything going on in Korea during that minor sell-off, not minor, I should say, it was actually a major sell-off in Korea. You did have this sell-off in some of the AI related, semiconductor related, optical related, anything to do with data centers and data center infrastructure in the US. Those names sold off pretty aggressively as well. So what I'm trying to say is this sort of positive price action and positive reaction to SKHY. I think the stock even faded in the late hours of today when the buyback was announced. because it was sort of a blah announcement. Like that's a typical retail move to rip that stock on a buyback like that that's so tiny. And then as more mature investors are going to go through what that truly means and what's going on in the marketplace and what we're reading about token prices and what we're reading about the competitiveness in AI models with some of these open source models in China. Like there is a lot of, I wouldn't say pessimism, but I would say there's starting to be some concern about the space. And that also is going to translate into the overcapacity build of memory factories. And so, anyway, I just think that this buyback is sort of a non news item, doesn't really move the needle, and is not a super important topic, not as important as some of the memory community sort of took it as. Anywho, I just thought the stock reaction made zero sense, and I was going to mention it on the podcast today. We haven't had a ton of news going around, so this is one of the bigger things that has happened. And I sort of thought the reaction was dumb, so I thought I'd mention it. Now, the next thing I want to talk about that is largely silly is nobody has been, I don't think anyone's a stranger to what's going on at the long end of the curve in interest rates. So, if you've been watching the TLT, you've been seeing the TLT get decimated the last few days, with the exception of Wednesday. You've seen bond yields spike. I think the 10 years almost at a 52-week high. I think the 30-year made like a 52-week high, or is at least close to. Like the long end of the curve from like 10 to 30 years out is at some really notoriously high levels and is starting to cause some pain. Maybe not necessarily in the stock market, but is definitely causing pain for, I think, people in the economy. And the Treasury Department today announces that they're altering this mechanism that they have. It's the liquidity support buyback operation for long end bonds. So it used to be a $2 billion operation every time the operation occurred, and now they're doubling it to $4 billion, which sounds like a lot to go from 2 billion to 4 billion. It's a doubling. My gosh, that's crazy. But remember, like these markets are in the trillions of dollars, like $4 billion in the grand scheme of things, in that market for long end treasuries is really a drop in I would say not even just a bucket of water, but a drop in like a pretty large lake. And so I think this is sort of just symbolic. It's a little bit of symbolism. I think the people in Washington see what is going on with interest rates, and they're like, we have to do something. We can't just sit on our hands and pretend this is not happening, because it's going to start to impact the stock market. And like I said, it's already impacting some of the people on Main Street as well as Wall Street. And so I think this is sort of, again, like the SK Hynix buyback is a band-aid over top of a gunshot wound, and you're still, squirting out blood everywhere, but it's like a small temporary fix to what is a large structural problem. And just so everyone's clear, this is not quantitative easing like when the Fed buys bonds to sort of inject money into the economy. What the Treasury is doing here is they're buying an old bond and then issuing a new one. And so the actual total debt level doesn't change. So the Treasury basically buys an old bond and issues a new one to pay for that purchase. The total debt is unchanged, like I just said. Now, if I had to frame the problem here and what's sort of going on, AI borrowers are now eating 40% of investment grade issuance at 15 plus year maturities. I'm just reading some of the notes that I made down here. So the Treasury is competing with these same buyers in the same market. So again, my hot take on this is that it's not a very effective mechanism for dealing with the long end. I think this was sort of a headline gimmick. How can we alleviate some of the stress in the market without actually having to do anything too drastic? I mean, if you truly wanted to address the long end of the curve, you would look at legitimate ways of exiting Iran, cooling off oil prices. You would look at ways to manage deficits. Total government debt is at the highest level it's ever been in history, even after you adjust for inflation. There are legitimate structural problems, like I said, that are much larger than anything a $4 billion purchase operation is going to do at the long end of the curve. And so I think this is posturing, and it's just a bit of a gesture. And I think the timing of it is what's so telling. Obviously, like I said at the beginning, we've all seen what's gone on with yields at the long end. And so to announce this now, it sort of shows the Treasury's hand is that they are worried about what's going on in the bond market. And that Washington in general, the Republicans in general, and we've discussed this theme on this show at great length before, are very in tune with what's happening in the stock market. You've seen it many times in the Trump administration, and now the Treasury, where Scott Bessent runs the Treasury. He sees what's going on in the bond market. Donald Trump sees what's going on in the stock market, and they specifically time these announcements for when things are not going so well. Okay, I'm going to say something that's going to put a bid back in the stock market. Okay, I'm going to say something that's going to put a bid back in the bond market and cool off yields a little bit. I mean, you saw what happened to the TLT today. I watched the TLT trade all day today because I was in utter shock that the TLT was going to bounce like that based on such silly news. And factually, if I had to make a call right now, I don't give any advice on the show, but that felt like such a squeezy-ish move. I think that's going to get faded pretty quickly, and that's probably a good level to start shorting some more bonds. But again, I don't make any sort of suggestions or give any advice on this podcast, but that's something I would start to do because I think that Treasury announcement is pretty big malarkey to me. So anyway, that's all I wanted to say on SK Hynix and all I wanted to say on the Treasury. I thought those were two silly things that I saw this week. There's been plenty of earnings this week. Some of the smaller companies, not as many big ones anymore, but Estee Lauder reported really well today. We got a report from Analog Devices. We got a bit of a growth slowdown in Klarna yesterday. Baidu reported yesterday. It didn't look too good, but then bounced today. I think that was because KWeb had a nice bid today. Fabrinet reported pretty good, but actually sold off regardless. And then this morning had this really interesting price action that I was watching. Looked like it was going to rip on the open because everything was ripping on the open given the fact that bond yields were falling out of bed. So I thought tech was going to get this insane bid. But interestingly enough, the semi sold off on the open, sort of stayed weak throughout the session. And Fabrinet, which is a classic AI name who has a lot of exposure to the semi and AI theme, sold off really hard on the open. And I'm sort of kicking myself in the back here because I sort of thought I wanted to short that name. I just didn't think that today was going to be the day given what yields were doing. I thought you were going to see this pretty strong bid in the market, which didn't end up being the case. So anyway, just tells you that even I can be wrong sometimes. And don't worry, I'm wrong a lot. Let's move on to my trading tip for today. This is one I discussed, I think, on an episode a long time ago, but it's about a question I received recently. What do you do when you're in a drawdown or when your confidence is shot? I mean, I've discussed confidence many times on the show. I've discussed drawdowns many times on the show. They are things I've experienced to this day many times before, and I'm no stranger to them. And I think the best thing you can do sometimes, I'm not saying this is the first thing that you should do, but if you've tried everything, you've done all your confidence exercises, you've tried to cut back your size a little bit, you've adjusted your strategy a little bit, or maybe you're trying something outside of the box and a strategy that you haven't really tried before, but you've back tested it and you feel confident in it. Once you've exhausted all things, if you can't get your mojo back, it's sometimes not the worst thing in the world to just take a couple days off. Take a day, 2 days, 3 days, whatever you need. Obviously, don't take months away from the market. I'm never an advocate for that because I think there's so much opportunity in the stock market, bond market, whatever market you're watching, crypto market, currency market, you name it. They're just watching the macro economy and micro economy unfold and reading earnings reports and staying in the groove of things, I think is extremely important for not only your growth as a trader and as an investor. It just keeps your mind sharp, I think, at all times, and that's always going to serve you well. So I never am going to advocate for a long hiatus from the marketplace unless you find yourself treating this like a casino and you're gambling a lot and you truly do need to remove yourself. But if you're a good trader and you stick to your rules and your disciplines, but you just can't seem to get it for a couple of weeks and you seem to be losing money on every single trade and it really doesn't feel like things are clicking for you, taking a few days off is not the worst thing in the world. And it doesn't mean you have to completely remove yourself from the market. Like, sit there and watch. There's been days where I haven't traded all day. I sit there, I watch, I get a feel for the tape. I start to, make some notes about things that I'm seeing. Because when you're trading, you're focused on that name. And you might be focused on a few different names that you're trading or things that are laterals or comps to the names that you're in, or maybe the ETFs that hold the stocks that you're in. You're trying to you're sort of you're paying attention to a lot, but it's focused on the things that you're trading. But when you're not trading anything, you sort of have this freedom to, okay, I can watch a few different markets today, or I can watch these stocks that I don't typically watch. Oh, what's going on in gold today? What's going on in silver? What's going on with the 10-year? There's so many different things. So many different things you can pay attention to. Your aperture of focus widens, and some of the stress starts to remove from yourself. You start to remove some of that pressure that you're placing on yourself to trade well. And I'm not going to sit here and say you shouldn't place pressure on yourself to trade well. I'm a big believer that the best performers in the world do have an adequate level, a healthy level of pressure placed on themselves to perform well. Because if you don't have that, you're never going to reach that pinnacle of success, that summit of success. Sometimes taking a day off is beneficial. No different than when you're working out 7 days in a row. A rest day on day 8 is not such a bad thing. It's going to help you be stronger on day 9. And so that's my tip for you, all you traders who are maybe not having it click recently. Take a breather and just watch the tape. Take it all in. Sit here and watch the tape, watch things unfold, and be focused, but don't be focused on trading. A good trade will pop out to you when the time is right. And you're going to put it on, you're going to trade it great. And if it's a winner, awesome. If it's a loser, you'll trade the loser properly, awesome. But all I'm trying to say is sit here, be patient. And if it's not happening for you, there's no shame in taking a day or 2 off, maybe even 3 days off, just to collect yourself, watch the tape, get ready, get situated, and be prepared for the next trade that you put on. I think that's sometimes the best thing I've ever done was when I just take a day. Hey, I'm not going to trade anything today. Nothing really stands out as a great idea. So I'm not going to put on a mediocre idea. I'm just going to sit here and watch. And sometimes, like I said, that's the best thing I could have ever done. So, folks, that is the episode. Thank you so much for listening. Like I said, my name is Alex Savanovich. I hope that wasn't too much word salad for you today. I felt like we discussed some good topics there. It is sort of a quiet period. This week and next week of August are sort of the more traditional quiet periods of the calendar. It's sort of that second vacation time for people in New York. And so there's not a whole lot going on. I noticed the syndicate calendar was pretty quiet this week. There was only one deal that opened broken. Funnily enough, we didn't discuss that on today's episode, but it was one that I participated in. But anyway, doesn't really matter. I hope you all have a fantastic Friday. But before I wish you a great weekend, make sure to follow me on Instagram, on TikTok, and on the YouTube Shorts. I post all the short form content on there. And like I said, I hope you have a fantastic Friday, an even better weekend. Take care, and I'll catch you on the next episode. The content of this podcast is provided for informational and educational purposes only and should not be construed as financial, investment, legal, or tax advice. The views and opinions expressed by the host and any guests are solely their own and do not reflect the views of any employer, firm, or affiliated institution. Any examples or strategies discussed are general in nature and may not be appropriate for your personal circumstances. Always consult a licensed financial advisor or other qualified professional before making any financial decisions. The host and production team assume no liability for any loss or damage resulting from reliance on the information provided in this podcast.